So I want to welcome everybody to this evening's Let's Talk About It discussion, where we're going to be talking about our third investment strategy. So a few weeks ago, I laid out 7 investment strategies for Black economic power. The first one was digital assets, and we talked about Bitcoin treasury companies a week ago or 2 weeks ago. The second one was real estate reimagined, in which we talked about the use of community land trusts in order to buy and control land, specifically starting in Detroit. And today's third strategy is investing in tech equity and innovation. And so before we start, we always want to go over our disclaimer. So let me pull that up and go over it real briefly. This discussion is strictly for educational purposes only, and we strongly encourage you to consult licensed financial advisors, attorneys, and tax professionals before making any significant financial decisions. And though I do have decades of experience managing hundreds of millions of dollars, I am not licensed or registered with any regulatory authority. And then, like last time, I'm going to kick it off with an overview video of the presentation. And then I'm going to put in the chat the link to the presentation so that you can download it and you can follow along once the video is over. So we'll start with the video and then I'll jump right into the presentation.
All right, today we're going to break down a really powerful idea. How we can really build wealth by getting in on the next wave of tech. And look, this isn't about just using the latest app. It's about owning a piece of the action. And this quote right here, it really sets the stage for everything we're about to talk about. It's a call for a huge mindset shift, moving from just being a passive consumer to being an active owner, an active builder. Okay, so let's dive right in. Okay, so first things first, why are we even talking about tech, and specifically AI, as this incredible engine for building generational wealth? What makes it so different from everything else? Well, it really boils down to 3 key things. First, you've got compounding scale. That means it can grow like crazy without the costs exploding along with it. Second, there's what's called data moats, which is just a fancy way of saying they have unique data that old school industries can only dream of. So this is a great way to picture the entire AI industry. Think of it like a ladder, a value chain. Down at the bottom, you have the chips. That's the foundation. You climb up a rung, you get to the infrastructure, the cloud. Then you've got the models themselves, which are kind of like the brains of the whole operation. Above that are the apps we all use. And right at the top are the services that get delivered. The big takeaway here, there are opportunities to invest at every single step of this ladder. Okay, so if that's the why, the big question is how, right? How do you actually get a piece of these opportunities? Let's get into the practical pathways. And just a quick heads up, of course, this is all for educational purposes. This is not financial advice. You've got to do your own homework. The source material lays out a few different ways to get in the game. You've got your public stocks and ETFs. That's the stuff anyone with a brokerage account can buy. Then things get a little more interesting with private placements and syndicates. That's how you can get in on those super early stage, higher risk deals. You've also got revenue share deals, which is a more direct way to share in a company's success. And finally, there's something called secondaries, where you can buy shares from early investors or employees who are looking to cash out a bit. Now this is super important. It boils down one of the most critical parts of checking out a company to a simple question. Are you looking at real solid traction, or are you just looking at a high cash burn? To put it another way, is the company actually building a real, sustainable business, or is it just burning through investor money like there's no tomorrow? And because we're talking about a pretty high-risk space here, smart investors, they don't just jump in head first. No way. They use strategies like staged entries, dollar cost averaging to handle those wild price swings, and of course, proper position sizing. I love this one. They even do pre-mortems, where they sit down and think through every single thing that could possibly go wrong before they even invest a dime. It all comes down to one word, really: discipline. All right, let's switch gears a bit and zoom in on a really revolutionary corner of the tech world. We're talking about decentralized finance, or DeFi. And trust me, this is aiming to completely rewrite the rules of the financial game. So what is it? The core idea behind DeFi is to build financial services that aren't run by some big central bank or corporation. Instead, they just run on code. The promise here is a system that's more transparent, more efficient, and way more open. And that could open up huge opportunities, especially for communities around the world that have been left out of the traditional system. And just so you understand the kind of scale we're talking about, let's look at a few examples from the source. You've got a project called Athena, and it has attracted over $12 billion in value. That's a lot. And then right behind that, you have EtherFi, another protocol with nearly $12 billion locked in. Again, these are massive, massive numbers for single projects. But this one is just staggering. Hyperliquid, which is a decentralized exchange, has handled a cumulative trading volume of over $2.5 trillion. So let's be clear, this isn't some niche little experiment anymore. This is a massive amount of economic activity happening completely outside of the old school financial world. But, and this is a big but, this table shows you there's no such thing as a free lunch, right? Each of these protocols makes money in a very different way, and each one comes with its own set of very specific risks. Athena, for example, relies on these really complex trading strategies that have to be managed perfectly. Ether.fi, it faces technical risks, bugs in the code or issues with the underlying network, and Hyperliquid has to deal with the pure chaos of wild market swings. The point is, you have to understand where the money's coming from to understand what the real risks are. So, given those very real risks, you absolutely need to have a clear set of rules for how you engage with DeFi. And the source material lays out a really practical playbook for doing just that. Okay, rule number one, first and foremost, your security is non-negotiable. The source calls this wallet hygiene, and it's all about the fundamentals. We're talking about using hardware wallets for any significant amount of assets, constantly checking and revoking app permissions, and I can't stress this enough, always sending a tiny test transaction first. Look, these aren't just suggestions. They are absolutely essential to protecting your stuff. And then on the other side of the coin, these are the huge red flags you have to look out for. Unaudited code, that means no one's checked it for major security holes. Opaque tokenomics, that means you have no idea who owns most of the supply or what the token is even for. And governance capture, that's when a supposedly decentralized project is actually controlled by just a tiny group of people. Any one of these can be a giant warning sign that something is seriously wrong. So all of this, the tech, the finance, the risks, it's all building towards this final big picture idea, the vision of Web3. And this is about fundamentally shifting the power dynamics of the entire internet. See, in the internet we have now, you might call it Web 2, we're basically just users. We use platforms like social media or search engines, but we don't own them. We don't own the value that we create for them. Web3 wants to completely flip that model on its head. The whole goal is to turn users into owners, to give people a real, tangible stake in the networks and apps they help to build and grow. And think about it. When users become owners, suddenly their incentives are perfectly aligned with the health of the network. It creates this incredibly powerful feedback loop where everybody wins as the network grows. And that's really the heart of it all, this deep, profound shift from just using something to having a real stake in its success. So what does this all mean for you? Well, it's really a call to start seeing technology not just as a tool you use, but as an economy that you can participate in, contribute to, and even help build. It's about changing your mindset from just being a consumer to becoming a creator and an owner in this new digital world. And that brings us to the final thought from the source material, and it's a really powerful call to action. Stop waiting to be rescued. Be the rescue. It's a challenge, right? It's a challenge to educate yourself, to get in the game, and to take ownership in this new technological frontier. So the real question it leaves us with is, what will you build?
All right. So that's the overview. And unfortunately, I wasn't able to increase the volume. Sorry about that. So let's jump into the presentation. And if you have any questions or comments during the presentation, feel free to jump right in. So we're talking about investing in tech equity and innovation, right? Ownership, access, and community-powered returns. So the video went over why tech and why now, and specifically starting with AI. AI is a technology that is going to forever change our society, our human society. I think they call it the fourth or fifth revolution. You know, you had the industrial revolution, and now you've got this AI technology revolution. And when people think of AI, they really don't know the different pieces of the value chain that come with AI. And so let's break down the supply chain, the value chain, and how we as investors can invest in different parts. So it all starts with the chips. And that's why NVIDIA is the largest company by market cap in the entire world. It exploded out of nowhere because of its GPUs. It's over a $4 trillion company um, because it builds the chips that power AI. Now, it's not the only company, but it is the 800-pound gorilla in the space. But the chips have to go into servers. The servers have to go onto racks. The racks are then put into data centers. Data centers consume huge amounts of energy and water. And so there's a massive undertaking of building out the infrastructure for AI. In the first half of 2025, there is there is more money invested in the infrastructure of AI than all of the consumer spending in the United States. Okay. The economy, the nation's GDP, two-thirds of it is based on consumer spending. But right now, the economy is being held up and pushed forward by AI and AI investments. You have companies that are investing hundreds of billions of dollars to build out the infrastructure. You have Meta, which is building a data center the size of Manhattan in, I forget which state it's in. I think it's in Louisiana. Um, and you have these massive data centers that are going up throughout the United States and throughout the world, and they consume a lot of energy. And so in the United States, our electrical infrastructure, the grid, um, doesn't have the capacity for all of the energy demand. And so that means trying to bring on energy generation that sparks new types of technologies and innovations. Um, and so just at the infrastructure level, there are a lot of different companies to invest in. Again, from the companies that make the servers and racks, the companies that build these data centers, construction companies, energy companies. There's a lot of different ways to invest in AI other than NVIDIA. Then, of course, you have the companies that are building the AI models, right? Um, it's the Magnificent Seven. They're all investing heavily in building their AI models, and they're just throwing billions and billions of dollars um, at building larger models that consume more compute power. That means more chips. That means more energy, right? And so you can invest in any of the magnificent seven tech companies in order to get into the AI play that way. Then there's the applications. This is where, again, you go back to the Magnificent Seven are the dominant players, but do you have other niche players that are building um, applications that target a specific industry or perform a specific function? And those applications actually seem to do better than the um, OpenAI and the Copilots and the Gemini applications, which try to do everything. And then finally, we get into the services. So you've got almost every company trying to adopt AI because they see AI as the future. They see the AI as the ability to cut costs, the ability to run their companies more efficiently. But there was a recent study from a prominent university that said that 95% of AI projects that are run by major businesses fail because they lack the expertise to implement them efficiently. And so that opens up a whole industry of providing technical services to companies to implement their AI projects. So AI is huge. It's one of those technologies that's going to have, again, an impact on our society for the rest of our lives. So, how do you invest in AI companies? So, you can go through public equities and ETFs. Uh, you can buy Microsoft, you can buy Meta stock, you can buy the Magnificent Seven ETFs. Those are real simple. You go through your brokerage account. Um, then there are private placements and syndicates. This is where the rich money plays. Uh, these are where private equity is dumping billions of dollars into OpenAI, into these other private companies. Um, that's the world that the typical person doesn't have access to. But through CPIN and our cooperative group economics mindset and pooling our resources together to invest in private placement and early stage companies, we're going to give our members access to some of these early stage companies. And then there's revenue share deals and secondaries where you're buying stock from employees or from early investors. You want to make sure that you do your due diligence. You want to make sure that the company has traction versus just burning money. For those of us that are old enough and lived through the dot-com crash, at that time, companies just put a .com on the back of their name, and um, they were getting money and just burning through money. Um, and 95% of .coms failed. And we will have that same type of flushing out of companies that are going to burn through money and aren't going to produce any money. And so you want to, when you're investing in early stage companies, especially those that are private companies, you want to look at those that have real traction and have a real business model versus those that are just burning through money. A moat, also called a barrier to entry, those that control their data that they're relying on have an advantage versus those companies that have to rely on somebody else for their data, especially if they're building models. You want to look at the unit economics, and for early stage companies, you want to look at founder market fit. Are these people that are experts in their fields and they're passionate about what they're doing, or are they just serial entrepreneurs that start companies and move on to the next and don't really have a vested interest in the long-term success of the company? So here's how you manage risk. Um, you want to um, make sure that you don't get caught up in the hype cycles. You want to beware of companies that have high capital expenditures. We're seeing that right now with companies that are spending hundreds of billions of dollars for building out the AI infrastructure, but they may not see a path to profitability. You want to be aware of the evolving legal landscape when it comes to regulatory and AI safety. And you want to be aware of platform dependency. Is this company um, reliant upon a specific platform, or do they have the flexibility where they either control their own platform or it's platform agnostic where they can move from one platform to another platform? Here's some strategies. Stage entries. Don't put all your money in at one time. As a company moves through stages, you may put a certain amount in at the seed stage, and then you may put another amount in at the A round if you're able to get in to investing in private companies. Dollar cost averaging is a great way to invest in public companies, to where you invest the same dollar amount each period of time, whether it's each paycheck or per month or per quarter, regardless of the price. And so that way you do the dollar cost averaging into owning the asset. Position sizing, we go over this in detail in our class, um, how to evaluate an investment opportunity. Position sizing is very important. So you want to look at your entire portfolio and how much are you going to allocate towards certain positions. Pre-mortems, you want to identify failure points, and those may be where you exit. If such and such happens, then you're going to cut your losses and then you're going to move out. So let's move on to Fintech and DeFi. So if AI is the new technological revolution, then fintech and DeFi are building the rails upon which the new financial system is being built. Um, so right now, the world's banking system is based on centralized systems. You have central banks. Um, you have banks that have their own banking system, and so that makes them um, security targets to where they have one point of failure can risk the entire network versus DeFi, which is decentralized finance. It's based on the blockchain. The blockchain is distributed, um, and so there's no one point of failure. It's highly secure. It's programmable. Finance allows you to use smart contracts, and it's reshaping the financial landscapes. It's also offering new avenues for capital generation. Through fintech and DeFi, you're able, as a regular person, to buy the tokens, the cryptocurrencies of these companies, and to be able to get in early um, and to participate in um, the financial results of these companies. And so I've just listed three that um, were listed by a well-known Black um, crypto expert, Arthur Hayes. Um, and he talks about Athena, which has over a $13 billion total value locked. It is the number three stablecoin issuer by supply. And so the government just passed the Unity Act, which established the regulatory framework for stablecoins, and Circle, which is, I think, the number two stablecoin issuer, just went public, and its stock tripled on day one. And so stablecoins are the new currency for the decentralized finance. EtherFi. EtherFi is a Ethereum um, protocol, allows you to stake your cryptocurrency and to earn yields. It has almost $12 billion of total value locked. And then there's Hyperliquid. Hyperliquid is a decentralized exchange, and it is where 80% of decentralized perpetual contracts called perps. Um, it is the number one platform for trading this new type of financial derivative. They've done over $2.5 trillion in volume on perpetual contracts. Um, and so these three companies are great examples of um, decentralized and fintech companies. So I'm not going to go through this in detail, but you can do a little deeper dive into each of these three protocols, um, how they make money as far as what's called their yield source, and what are the risks. And so we have to always be cognitive of the risk, and we have to manage the risk. And so here's a DeFi playbook. Wallet hygiene is paramount. This is where the phrase, not your keys, not your coins, comes into play. So if you have a wallet of any significant value, $10,000 or more, you want to implement these wallet protocols. Recommend getting a hardware wallet rather than just a wallet that's linked on the internet. Also look at doing a multi-sig wallet, but it's a multi-signature wallet. There are protocols that set up wallets where it requires where there's three signatures and it requires 2 out of 3, so that if you lose your keys, you can still have access to your funds because one of the signatures is a company that just can verify your identity and sign off on your behalf. That's extremely important when you start getting wallets of value, because when you have a non-custodial wallet, right, where you have the keys, if you lose the keys to your wallet, then you are asked out, not going to be able to get access to that wallet. And so when you start getting values that are up there, you want to look at these multi-signature wallets, these hardware wallets, um, and no matter what the value of your wallet, before you start interacting with these different protocols, you want to send test transactions. You don't want to be sending thousands of dollars as your first transaction. You want to send the minimum amount, make sure the wallet address is correct, make sure everything is on the up and up. Um, and then position rules for securities. Um, you want using platforms that are where you're trading. Um, you want to, these are more advanced strategies. Um, and so as you get deeper and deeper into DeFi, then you'll definitely want to learn these more advanced risk management strategies. And then there's these red flags. And so unaudited code, you do not want to invest in a protocol where the code hasn't been audited. Um, there are horror stories of great protocols, great projects where someone came and took the money out of the protocol because there was a security flaw in the smart contract. And so you want to make sure that you're not investing in a protocol where the code hasn't been audited. Um, you want to understand the tokenomics. You want to make sure that there's not the ability for a rug pull, for pump and dumps. Um, just want to have good sound tokenomics and how does the protocol actually make money, and then governance capture. If it's truly a decentralized project, then you want to make sure that there's not just a handful of wallets that control all of the supply or control the governance. And then we come to our third subject on this topic, Web3 startups. And we are currently in Web2, where we can interact with websites, but we don't have any ownerships in the websites, right? We interact with Facebook, we interact with Instagram, we interact with YouTube, and we upload all types of content. And as soon as we upload that content, we lose ownership of that content. And then the company that, and the platform that we upload it to, they now make money off of our content through advertising, and that advertising isn't shared with the users. So Web3 presents an opportunity to totally change that. It shifts the power back to the users, giving the users the ownership of their data, giving them the right to determine who they share their data with and how do they get compensated. It's permissionless Rails, and so it's the creation of brand new platforms that aren't owned by, the magnificent seven, aren't owned by a major corporation, but are owned by the users. Um, you're looking for Web3 companies that have real user utility solving tangible problems for everyday users. You want to make sure they have sustainable tokenomics. Tokenomics is just a business model, right? Um, that they have a business model where they can become profitable within a short period of time. And if they're truly decentralized, they'll have community governance. And so this graphic shows the how they're all intertwined. The users who are the owners, um, the benefits are reinvested, and that increases network value. So here's a quick case study. Karma Coin. Karma Coin is a new Web3 project. Um, the website is payoffyourkarma.com, and it's a project where people can buy the coin, and then 50% of the treasury goes to fund projects that help humanity. And so it's a way for people to pay off their, any past bad karma that they may have by putting money into projects that are helpful. Brand new. It's been around for less than 2 months, but it's a project I recommend that you take a look at. Um, uh, Full disclosure, I am getting involved in the um, part of the management team for this company, helping them with setting up and running their back office, the evaluation of the projects that they're going to be investing in, as well as taking a look at the tokenomics. This is the type of project where it's an early stage project. Yes, it's high risk because, like any startup, there's high risk, but it's been in existence for 2 months. It already has a market cap of $7.5 million. Over 2,500 people have invested in it. And the whales, the large investors, have not come in yet. And so it's the perfect opportunity for someone to come in with a small amount of money, and to help a worthwhile project that could also have a huge return. Um, and so that's just one example of a Web3 company that's doing good. So all of this comes down to stop waiting to be rescued. We are the rescue. And so I invite those who are not members of the Closed Private Investment Network, CPIN, to join today. I'll put a link into the chat. The CPIN is built on 3 pillars. The first one is community. We're a community of like-minded people that practice cooperative group economics, where it's not about one person maximizing their profit, but it's about maximizing the benefit to the community that we belong to. The second pillar is education. And so we have a knowledge center where we have various courses on finance where you can learn more about finance. We want you to be a better educated financially so you can make better informed financial decisions. And then the third pillar are curated investments. These are where we evaluate investments to make sure that they are sound investments, that they are in line with our cooperative group economics. And then we present them as investment opportunities to our accredited and sophisticated members who are then able to pool their money together with other members and invest in them with as little as $100. And so I do invite you to join the Closed Private Investment Network. And with that, the presentation is over. And now I'm opening it up for discussion. Any questions, comments, anything? You can raise your hand or just unmute yourself. All right, I'm just going to start. Go ahead, Leroy.
Okay, this is very, all of your presentations are very interesting. I noticed that you mentioned private placements, and I had had a conversation with you before. So private placements and syndicates is one of the pieces that are tied in terms of possibilities.
Yes, and so most of our investment opportunities that are presented on the platform are formed as private placement offerings, in which we create a special purpose vehicle, an SPV. That's a legal entity that is created specifically to invest in one type of investment. And then that private placement offering is kind of structured like a mini fund in which the NIC network is the general partner. We manage the legal entity. We make all of the management decisions. And then investors, which are the CPIN members, are limited partners where they provide the capital. And so once we reach the investment goal for raising the amount of money that we're looking to raise for that specific private placement offering, then the BNIC then goes and invests that money in that specific investment, manages it, and then returns the profit. And the BNIC network receives its management fee strictly from the profit. So it's performance based. So yes, private placements are at the heart of how the closed private investment network invests money. Any other questions, comments? Mark, you're quiet. What did you think of the presentation?
I don't want to. I always get on here and hog up time, man. But I echo Leroy. Excellent. I'm centered in on this based upon my project. It's another form of karma point, if you would, but with a real world twist utility. I would just stress to people. What I would stress to people is this is a great example of the power of this technology. Or let me say this. The internet, when the internet came to the market, it leveled the playing field. So we saw people be able to compete with corporations. Today, with this technology, we're seeing teenagers spin out businesses that are driving tens of thousands, hundreds of thousands of dollars. And I know from my experience and Mike's experience, I've used AI to do things that either I could have never done myself 2 years ago and would have cost maybe $5,000, $10,000 to create. Um, so all of this technology really puts the tools in our hands to save ourselves. Um, and it takes this type of conversation, engagement, questions, curiosity, and constant exposure to this, if you would, echoing 19 keys, high level conversations to be able to understand it to the point that you'll start walking in it. We all got to get to the point that we're walking in it via the investment vehicles, which CPEN provides, and then from doing the investment vehicles, finding that you can introduce this technology into what you do in your day-to-day life, be it to simplify your life or to be to 10x your business or bring an idea you never had to the market. Because all the tools are there now. If you can think it, you can figure out a way to bring these tools together and make it happen. So that's my input.
Thanks, Mark. And Lorraine, good to see you. What did you think about today's discussion presentation?
I think it's pretty cool, especially launching investment companies and using, I guess, the decentralized technology. Just one more thing to learn, and it's interesting to see the growth of it.
Yeah, we are truly living in an exciting time, and the rate of change is only increasing. And I think within the next 5 years, it's going to totally change how we live, how we do things, how we interact with each other. Yeah, Mark, you had your hand up again.
I want to echo that and pick up what I was saying is within that time frame, Michael said, I truly believe in my core, and I think Michael does as well. This is a window of opportunity that to create life change and wealth. And if you're smart with it, you really can position your family to exit the system, if you would. But it's going to take discipline, strategy, focus, effort. Uh, but that window is available. And the growth is crazy fast. It's lightning fast. Never seen anything this fast. It moves so fast, which is why it seems overwhelming to keep up with everything. But if you get these tools can help you kind of curate that information, put it in front of you in bites to help you keep up with things. But yeah, I would just echo that life-changing opportunity in front of us, just period. And it's lightning fast, so can definitely feel overwhelming.
I do have a question though, because a lot of the traditional methods still work. And like when I hear people talk about, like if you listen to the Wall Street Journal's they talk in terms of percentages of how much you should be allocating or incorporating these things into your portfolio. Because it's still like new, and then the old methods of making money still work, and it's probably going to still be the standard for a very long time. So I'm curious, like, are y'all thinking in terms of percentages, or are y'all just pivoting? Like, this is a new opportunity.
I
Let's
would
just
say,
pop in.
uh, for me, I hear exactly where you're coming from. I think from the hardcore cash perspective, it's conservative. It's money you can choose to lose. So yes, that part there, you don't want to you don't want to take your 401k and put it all into this type of stuff. No, I think Mike would agree with that. But I think what a real opportunity is to build something, right? So and then you figure out with your financial advisor a plan that you want to, as this grows and becomes more part of the mainstream financial picture, which it will be, that your portfolio just matures in that direction as you get more comfortable and smarter with managing that risk. I think the immediate opportunity for the wealth, the life-changing wealth, is for those of us that raise our hands and build something on this technology, because the rising tide raises all ships. We know that part. The rising tide raises all ships. And just going through the process of building something, as Mike alluded earlier, you will come out with an expertise that you can end up contracting that out if you choose to. So I think the immediate opportunities is for those of us who raise our hands to build something. Rising tide raises all the ship. And I agree with you as well when it comes to our own money that we're setting aside for our future and our wealth creating, very conservative in playing in this space.
So the whole reason why I developed the 7 strategies for Black economic power is because we as a Black community are behind when it comes to our wealth. And so we've got to play catch up. And so we've got to play by different rules than those who already have wealth, right? So when you're looking to build wealth, you use different strategies than those who already have wealth and who are more concerned about maintaining their wealth. When you're in a growth mode, um, you have to have a higher risk tolerance, um, and you have to be more hyper focused versus once you already have money, you already have wealth, then you diversify because that's a risk management tool for maintaining your capital. So 2 totally different strategies. And the strategies that I laid out are specifically for the Black community that does not have that um, wealth, but is looking to build that wealth. And so that's why I recommend these 7 strategies that are, different than what Wall Street or your stockbroker or financial advisor may advise. We've got to play catch up. And so when it comes to a percentage of the portfolio that's put into what they call alternative assets, which is like real estate and um, gold and crypto, I would definitely recommend a higher percentage as long as you understand how to manage the risk. Yes, Leroy.
Yes, I want to follow back up. Looking at the 5 AI value chain opportunities, looking at CPIN right now in terms of rolling out and incorporating this. Are you looking at all 5 of them rolling out at the same time in terms of creating, or is it based upon different individuals coming with projects and things of that sort to fit in?
Yeah, so we'll be looking at different projects that fit within the value chain of AI. So so I am Black focused, right? I'm pro Black, and so my preference is to find Black companies that are within this space and to be able to assist them as long as they have, viable business models, and we can negotiate um, terms that create win-wins, right? And so there are some Black companies that are in startup phase that need capital, and so those are the type of companies that I am looking at, and that's one of the reasons why I laid out the value chain, because it's not all about investing in NVIDIA. It's not all about chips. There's all, you know, the impact of AI is very broad, and so we need to find the niche that fits us to where it can benefit us, and so that's what I'll be looking for and my team when it comes to AI investments. Serena, haven't heard from you yet. Um, I know that this is your first time, but I'm curious to see and hear what you think. Serena?
Hi, Michael. So the information it was a lot to take in for my first time and jumping in on the third session. So I'm just reading through the slides as well as going to the website for the CPIN. But I am interested in learning more about what you all are trying to build.
Great.
Thank
Well,
you.
we definitely welcome you, and thank you for coming. Um, and um, and then I see Mike Johns, a previous speaker on Let's Talk About It, has joined us at the end. Um, Mike, you missed a good presentation about um, about technology, equity, and innovations, um, and so. But what's been going on, Mike?
Oh man, I'm sure it was action packed. I'm sorry, right when I thought it was 4:45, looked up and it's darn near 6. So it's been fast moving. And so I really was focused on supporting you and supporting this movement. Happy to see some familiar name. I see Mark Armstrong in here, so shouts out. And yeah, just supporting. Clearly, I have a new book, Death of a Job. I'll get my shine on with that. I'll put it in the chat. We're moving. Things are really happening uh, in launch of that September 10th. We roll that out in Vegas you're on the campus of UNLV. And this is the first of its kind book that also features a soundtrack, kind of like a movie. So we'll be debuting it on the campus of UNLV and then later at Tech Week, San Francisco, Tech Week, LA. So I put the book in the chat. It's available right now on Amazon. I encourage it for you guys to cop that. It's your navigation guide to the future, looking at where AI and its impact its impact on work over the next 5 years and what you need to know how to navigate. So that's about it.
Well, thanks, Mike. Thanks for joining us. And we are here every Sunday, 5 p.m. Pacific time, 8 p.m. Eastern time. It's called Let's Talk About It, where we choose a different topic and discuss how it affects the Black community economically. And so today we covered strategy number 3 of the 7 strategies for Black economic power. Next week, we will cover strategy number 4, which has to do with becoming the lender and not the borrower. And so that is another strategy, becoming the lender and not the borrower. And so I invite you guys back to come next Sunday. And as always, bring one or two people as we continue to grow our community. And remember to become members of the Closed Private Investment Network. Any final questions or comments before we sign off?
Let's keep the support up.
All right. Thanks, Mark. All right, everybody have a blessed night and stay safe.
Thank you.
All right. Good night. Be blessed, everybody.
Bye.